At Staples Business Advantage, our team of experts can help you find the breakroom products to satisfy everyone's preferences, while AI can
suggest popular items, monitor stock levels, optimize pricing, and automate reordering.
AI can do a lot of things.
But I can never know the taste of a truly great cup of coffee. Sigh.
But you also can't get hangry.
This is true.
Let Staples Business Advantage use today's latest innovations, plus our team's experience, to make stocking your team's breakroom easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
None of these concepts are new. They've been there since the beginning of time. It's really just comes down to our behaviour, being successful with our finances and investing. And it's like this amazing soft skill that you don't actually need to have a degree to do well in. It just comes down to learning a few basic concepts and having that behaviour and the mindset to be able to stick out the volatility, the roller coaster of the markets.
G'day, and welcome back to Shares for Beginners. I'm Phil Muscatello. Normally, I don't like to do too much of the talking. That's what experts are for. They know what they're talking about, unlike me. Despite that, I was recently invited onto the Australian Finance Podcast with Owen Raszkiewicz and Kate Campbell from Rask Finance. They kindly let me ramble on a bit, and we shared some things that we've learned about markets and investing. Rask Australia is an Australian-owned diversified investment advice, news, research, financial education, podcast and money network. Try out their free courses and newsletter. Now, here's the chat.
You were coming at this from a beginner's perspective.
Yes.
When you and I have spoken previously about, I guess, the cherished position that we're in being podcast hosts, because we can absorb all this information from these experts. Mm-hmm. So Shares for Beginners, can you just tell us a little bit more about it? Are you just interviewing the best guests you can find, and how do you structure the series?
Yes, well, I'm looking for guests all the time that will give some sort of new information to listeners. Sometimes I find that I'm trying to find new things all the time to talk about, new subject areas, new ways of investing, new people to talk to. But basically, I'm looking for people who are have got interesting things to say and that have got really good lessons for investors. You know, one of the great examples, and you've had Andrew Page on recently. Mm. People love Andrew. I can just tell from the statistics of the podcast listening that he's one of the ones that really engage with the audience. So it's partly that, and it's partly just my own curiosity. If I find something that I'm curious about, I just look for the person that would be good to talk about. And I think because I'm coming from a non-financial services background, one of my slogans is, I'm not afraid to ask the stupid questions. And I think a lot of listeners have that experience where they want to learn about investing and they don't even know what the questions are to ask. And I feel like, we're proxies for our listeners, and hopefully asking the questions that they would like to have answered as well, and not let... It's very easy for some of these financial services people to get bogged down in jargon, especially fundies when they come on. But I seem to have been able to get this great relationship with some of the fundies and get them to talk in such a way that they're simplifying it, like they're talking to their mother. I always say, try and explain it like you're going to explain it to your mother. That's
great. Peter Lynch, author and investor, says that if you can't explain it to a 10-year-old or younger, then you don't know what you're doing. And I think it's such a good way for us to think about how we deliver messages. And it comes back, I guess, to that Feynman technique, the Richard Feynman, the physicist, who has this technique that when you try and explain it to someone else, it's only then that you realize there's gaps in your knowledge and you can go back and fill those in.
Yeah, he was a great bongo player, just as a side note as well. Did you realise he was a great bongo player?
No, I did not. That's a fun fact for today.
Oh, yeah, have a look at the book, Surely You're Joking, Mr. Feynman. It's a fantastic read. His autobiography, I think, but hilarious. He was a great character.
Yeah, I've seen some of his work just through some of the times that he spent on reviewing the space shuttles and stuff like that. And it's he just seems like a fascinating person.
Yeah, and his videos on YouTube as well. We'd urge listeners to explore Richard Feynman's body of work.
Yeah, he's certainly one of those ones that come at it from a kind of a multidisciplinary approach where you can bring many different ideas from different industries and weave them together. But back to the topic of investing, Phil, which is why I'm sure we could go on for a long time. But so now that you've been doing this for a while and you've been investing for a while, what have been some of the best things that you feel you've done, either with the podcast or with your own investing?
Well, with my own investing, I've been scared off. I've made so many terrible mistakes in the past with investing that I'm basically all ETFs now. Listening to the guests and meeting some of the people, and people like Andrew Page and Claude Walker from A Rich Life and some of those, I just realise how much work is involved in really fundamentally understanding what a business is doing. One of the best things I've done is join the Australian Shareholders Association. And if I may give a plug, because I've become very involved with the association, I would urge everyone to pay their $130 a year and join the association, because they've got members who've been investing for 40, 50 years and the knowledge that they have. I mean, one of the best things was going to their member meetings. Have you ever been to a Shareholders Association member meeting?
No, I haven't.
Yeah. I walked in one day and I thought, oh, this is the Association of Retiree Shareholders. And I was just wondering what I was going to get out of it. And then suddenly, when the discussion erupted, you just realise that these people, not only do they know about the companies, they know about all the directors of the companies and the management of the companies, the other companies that they've been managers and directors of, and the mistakes that have happened in the past and the things to watch out for. It's just an incredible body of general history in the share market. And I guess the other things that I've been learning about is, like you said, just from the guests. Did you want me to go through some of the list that I've got here? I've been writing a very long list here, Owen and Kate.
Some of the lessons, yeah, that'd be great.
Well, this is one from the Shareholders Association. Treating your investments like a garden, where basically you're just letting the good flowers grow and you systematically cull out the weeds. And just do this just on a very gentle basis for the long term. And that's the other thing, of course, investing for the long term. I've been finding, I've got a Facebook group now as well. If anyone wants to join up, look for Shares for Beginners on Facebook and start asking some questions there. And if you guys would like to join, that'd be great to join the discussion.
I think I joined last week.
Did you?
Bit of action going on then.
Oh, you did. You did. That's right. Yes. But what I think a lot of young people, they're coming into the market now. They've heard about Afterpay. That's it. You know, that seems to be the star stock. Everyone wants to talk about Afterpay. And they think, oh, I could make lots of money by investing in the share market. And I guess that's part of the warnings that you and I and all of us are trying to show, is that, no, it's not just as simple as having someone telling you what to buy. It's that journey word where you've got to learn so much about what you're doing yourself and doing your own research and looking for the systematic way of doing it, and also doing it for the long term. I mean, listeners have got so much time on their hands. Just be in there for the long term.
That's something that I noticed, Phil, just with even people that are a bit older. So even people that are approaching retirement, right? They may not think it, but even at the age of, say, 65, it's still probably 15 or 20 years that you'll have money invested. So it's important to think long term, even though you might not think that, you know, this money needs to get me by the next few years. It actually is still a long-term proposition for a lot of people.
It is. It's a long-term proposition, and you've got to be in there for the long term, because that's it. It's just no one can predict the future. That's the other one of the great learnings, is no one can predict the future. You've got to be in there for the long term. And the other great lesson, and this is something where I made mistakes in the past, is not being diversified, which is, of course, why I've retreated like a turtle, putting my head back into the shell, into the comfort of ETFs, where you're going to get that diversification.
Yeah, absolutely. And how did you start sort of figuring out these concepts? Was it before you started the podcast and you sort of slowly absorbed them, or is it all from your mistakes or from other people?
No, starting basically from joining the Shareholders Association, which was about the same time as when I started the podcast, and talking to some of the great investing minds that we have here in Australia.
We thought we'd get you on, Phil, and we've kind of already dived into some of them, because you do have so much experience personally, but now more so interviewing people and just immersing yourself. It sounds like you just jumped in with both feet into kind of accelerating your own knowledge and wisdom on this topic called investing. But we thought what we'd do is maybe go through 3 key lessons or 3 key ideas that we can bring to the listeners. And I figure a really easy way to do this, and we can do this, it'll be quite laid back, is just to maybe just go through some of the lessons. We've got 3 on our list. Kate and I, we put our heads together and came up with 3. But maybe we'll throw it over to you. I think you mentioned diversification, but was there something else on your list?
I think it's worthwhile repeating that diversification is the key. And if I can just expand on that point, I think people think that if they own shares in a bank and they own shares in a miner and then maybe shares in Woolworths, for example, that's diversification. What I've really come to learn is that the true diversification, and this is where your super money is invested, is asset allocation. And this is something I hadn't really realised until doing the podcast, that there are other asset classes like bonds, for example, and infrastructure and real estate that are available. You can buy them as an ETF, for example, to truly diversify your portfolio. And that kind of diversification, while it's not going to protect you in any kind of huge market downturn, it is going to give you some more cushioning than just being exposed to shares alone.
I think that's a big thing. And because this is a relatively new theme in investing is using ETFs and using the stock exchange to trade more than just stocks. I think this is a kind of a misnomer. People kind of think, oh, it's the Australian share market, therefore I can only buy shares from Australian markets on there. But what it really is it's actually an exchange, a place that virtually you can go and you can buy almost anything thanks to these ETFs. Our first lesson, and I'm going to fire this one off, is one that I've pieced together over the past 10 years or so, which is this idea that people have to stop trying to time the market. One of my bosses from the Motley Fool days, he came onto Twitter the other day. It's quite a rare foray for him. And he said, stock market investing isn't until the next market crash. It's for life. And we're taught from a very young age, I guess this conventional wisdom tells us that we need to buy low and sell high. That requires us to try and find the bottom, but also then to make the sell decision, which is two decisions that are very difficult. So I've kind of replaced those four words, buy low, sell high, with one word, and that's accumulate. And I think for the vast majority of Australians, and indeed probably 99% of the people that listen to this, it's not about trying to pick which one at what time, but more so about just accumulating as many of them as you can. And like you said, if you have a garden, put as many flowers in there as you can and get rid of the weeds along the way. And that's kind of a philosophy that I've touched on, but it's really just about stop trying to time the market.
That's correct. And my most recent episode was with Graham Hand from First Links, who is great. And he's got this great chart that he shared with us, and it's basically showing the S&P 500 going up and down over the last 20 years. And as it's going up, you can see he's written buy, exclamation mark. And as it's going down, it's sell, which is just one of the most basic things about investor psychology. And as you said, it's not about timing the market. It's about being in there, ignoring all that noise, no matter how far the market goes up and down, and just keep on putting in a little bit each week and just leaving it there for 10, 20, 30 years, hopefully.
Yeah, and I think that's really interesting. I've been reading Morgan Housel's new book this weekend, The Psychology of Money, and he really pointed out that none of these concepts are new. They've been there since the beginning of time. It's really just comes down to our behaviour being successful with our finances and investing, and it's like this amazing soft skill that you don't actually need to have a degree to do well in. It just comes down to learning a few basic concepts and having that behaviour and the mindset to be able to stick out the volatility, the roller coaster of the market. So I think that's, pretty much what you're saying as well. It comes down to that behaviour and actually being able to focus on the end result over a long period of time, not what's happening in the media right now.
At Staples Business Advantage, our experts can help you find furniture that fits any design and budget, while AI can
recommend products based on preferences, generate 3D models for visualization, and optimize space planning for office furniture.
take advantage of our team's eye for style and design.
And my eye for, wait, I have no eyes. Only algorithms.
Let Staples Business Advantage use today's latest innovations plus our team's experience to make furnishing an office space easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
human.
Kate, I think you're going to jump over to number 2, our second lesson, which we've talked a bit about already.
Yeah, so building on from Phil's point about the importance of diversification, I guess one of the big lessons I've learned in the last few years is that diversification isn't just about having dozens of tiny little investments in different shares and ETFs. Sometimes when you're getting started, you can get really excited and invest in like 5 versions of the same ETF, tracking the same Australian top 200 shares or something like that.
Yeah, that's a trap with slightly different weightings, yes.
Yeah, and I found you can get really excited when getting started with shares and end up with like $500 here and all over the place, especially as you're researching and you're just getting inputs from everyone. So I think that's when it comes down to it, it's not the path to success having dozens of little investments, because even with our friend Warren Buffett, most of his money is only made from a couple of the stocks in his portfolio. He didn't make his wealth from having been so diversified. He made his wealth from just a couple of really good choices.
And that's why we say, Kate, that's kind of the thinking that I've come up with, and what we kind of follow at Rask here, is that you can have the best of both worlds, right? You can have the ETFs because they're so easy to buy and sell, and they're so relevant to so many people, as Phil said, because they do provide that convenient exposure to different asset classes. But then you can also, if you want to, if you're so inclined, you don't have to, but if you want to, you can invest in individual shares and try to be like Buffett, if you will. So you can do that. But I think the mistake that people make most commonly is that they think, and this is an old school stockbroking philosophy, and I talked about this in one of our educational videos recently, where there used to be this thing called the race to 30, and it would be where you start with one share, obviously, your first one, and then stockbrokers or what have you would try and tell you, oh, you have to get to 30 because that's, academic research tells us that
that's true
30 shares is well diversified.
Yeah.
Yeah. And it's true that if, statistically speaking, that if you do get more shares, you do become more diversified, but there's better ways to do it these days. 30, 40 years ago when this research was coming out, that was relevant at the time, but now there's something new. And I think, I don't know what you think, Phil, but I feel like people nowadays are afforded a tremendous opportunity to have the best of both worlds.
Definitely. I think that, and it's, I think the approach, and this is something that I am doing because even though I'm mainly in ETFs, I'm starting to have a look at individual shares to buy into for the long term. And this comes to the next lesson that I've learned. And well, there's 2 parts to this lesson. One is I got from Claude Walker from A Rich Life, who said, match your risk to your experience. And that's such a valuable lesson. So when I'm looking at individual shares now, the bulk of my portfolio is in ETFs. But then when I'm looking at shares, I'm not risking a lot. I'm just doing a little bit at a time just to see and to learn about this particular company that I'm investing in. And the other point of that, and this is something that I can't remember who said it, but it's the idea of heads I win, tails I don't lose too much. And the importance of being able to, when you see something, when you're weeding the garden, my thesis for getting into a particular share or a particular company, when it's not working, just get out, cull those weeds.
I think that might have been a Charlie Munger quote, or at least maybe a derivation of it. It's a fantastic one. It's because it shows, it kind of reminds you of the asymmetric profile that is share market investing. You're looking for bets where it's 3-2 opportunities. So you're looking for those outsized bets. There is a tremendous book that's just come out. I know Kate has taken a few lessons from it. And we're talking about this and talking about behavior as something that people probably don't focus enough time on, Kate.
Leading on from Morgan's book, you can tell I have spent the entire weekend reading it. He talks a lot about how it's more about that behavior. And he has a couple of examples where people have more than enough money, like $100 million, but they don't know when is enough. And they keep taking risk, even when they don't have to. So I thought that was really interesting lesson to think about, because often when we're investing, the goalposts keep moving. If we're doing well, we want to do even better and better. And I found that, concept really, it's nothing new, knowing when is enough. But coming back to your own portfolio, you might keep thinking, I want to do better than I did last year. You want to beat your friends or something like that. And I really like that concept that just brought it back home. Knowing when's enough, knowing what risk is enough for you to take as well.
And having a methodology and having a system in place. So and this is something that you learn and develop over many years. I mean, I'm not good at it and I'm still trying to develop it, but I'm not sure if you know the QAV investing podcast with Tony Kynaston.
Yeah, I've heard of it, yeah.
Yeah, it's really worth a listen. And he's got a methodology. He's been investing for 25 years as a private investor, doing 19% per annum consistently. And it's a methodology that he's built up over a long period of time. And it's basically allowed him to make very, very good money and also to play a lot of golf and not even have to think about it and worry about it.
I think people often benchmark their financial, wellness and wealth against their income or against, let's say, a portfolio. We see that a lot of times in property circles is, tell us the value of your portfolio and so forth. But oftentimes, the true measure of wealth is how much humility you have. And that has nothing to do with like monetary rewards that you've accumulated. And it's just to do with your behavior. And I think, everything else that goes above and beyond what you need is just your ego. And I think that comes from a Morgan Housel quote as well.
I know this is the biggest mistake I make. It's called the Dunning-Kruger effect, isn't it? You've heard that term where you overestimate your own ability, and a lot of people overestimate. And this is one of the main things. This is one of the main lessons that I really always, for a long time, overestimated my ability, and without taking the necessary steps to learn, which is part of why I started the podcast, because I really wanted to learn from the best people. But humility is so important, and having some friends that you can talk to about it so that you can test your ideas out. Again, coming back to Andrew Page and Strawman, that model that he's put together where people can actually share their ideas, test their ideas, and argue with those ideas. I mean, you want to know what it's like in a funds management company. They're not just making an investment based on, I think this is a good idea. They fully research, they go and talk to the companies, and then they argue. They have these robust discussions amongst all the fundies, all going, well, should we do this? No, that's a terrible idea because of blah, 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 blah. But, this is a great idea because of blah, 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 blah. And having that humility to be able to have your own ideas tested and thoroughly researched as well, it's so important.
And it's often finding opposing views to your ideas as well.
Opposing views, exactly, Kate.
Yeah,
go for it, yeah.
Even when it comes to ETFs, you might be wanting to invest in something a little bit more niche, but actually looking at someone who doesn't have a positive outlook for that industry and actually going, does my research still hold true? Have I investigated all the other sides and the risks involved? On Twitter, you often only see the opinions of the people you follow, and you're usually only following the people that you like or you respect their opinions of. So you often get very siloed in your approach. So you actually have to actively go out and look for different ideas and opposing ideas. And we talk about that a lot when we're talking about financial media and getting two sides of the story. And you actually have to go and look for that.
Contrarian ideas,
Yeah, in investing, once you've done it for long enough, you realize the most empowering question to ask yourself is what sucks, is to invert the logic. And this comes back to a mistake that often beginners make, particularly with their behavior, or especially with their behavior, is that they think that the share that they have invested in owes them something. Yes. So they feel like they need to defend it. If someone has a criticism of Commonwealth Bank and I own Commonwealth Bank, well, that's not true. How dare you? When really, those are the views that you should be seeking. And as to Kate's point, this is something that I'm very conscious of as well. I'm a prolific user of Twitter, probably shouldn't be, but I often remind myself that it's important to follow the people that I don't agree with, whose investing strategies I don't think work, because those are the people that present the critical ideas that I need to question my own abilities and my own strategies. So that's really, really empowering. What do you think are some of the barriers that people face when they start investing in shares? And do you have any strategies to overcome them?
Again, this is something that I've learned from a guest, and that's to avoid information overload. It's so easy to get overloaded with information and you just don't know what's going on. And one of my guests, Doug Morris from ShareSite, lovely chap.
Oh, yeah.
His thought is that you buy a holding in a particular company. Now, it's a company that you might know, say Woolworths, whatever it is. It's just a company that you know exactly what they do, and that you spend a lot of time researching everything you can about that company once you've bought it. It's very important to have money in it as well, because it's not real unless it's your own money. And then to read the half-yearly reports and go to the annual general meeting. It's so easy now with virtual annual general meetings. Ask questions and find out everything you can about that particular company. I think that's a really nice, very good lesson, and I've heard that from a couple of other guests as well, because that is going to give you more lessons than any other way and will help you to cut through the noise and all the information overload. And I think part of that as well, part of avoiding the information overload, is not listening to analysts too much, because financial analysis is not what it used to be. It's more of a PR game these days than serious critiquing of a particular company and its business. I don't know if you've got any other thoughts on how to get started as well.
Yeah, just jumping onto your critique, I'd probably lump economists in with that one too. I find that they get paid a lot to stand in front of a camera and have an opinion on something, but oftentimes we think about
what's the definition of an economist? Someone who's good with figures but hasn't got the personality to be an accountant.
Well, you said it, I didn't, but I often think that people think about what's going on with the recession's coming, the coronavirus. What does that mean for the stock market? And politics. How does that influence the economy? And I just think that you're asking the wrong questions. Then someone has to fill that gap, so that's why they do it. But you're right. There's definitely PR there. There's one more question I think Kate wanted to ask.
Yeah, absolutely. So Phil, based off your experiences and the interviews you've done, do you think there's an element of luck involved with successful share investing? So yes, no, or to what extent?
That's a really hard question.
Yeah.
Having had bad luck, being born under a bad sign and having a lot of bad luck in investing, I think that luck has a lot to do with it. But I think that you make your own luck. But then, a mate of mine last week, he just said, I've bought some shares in this particular company. And I said, why? Because they've just signed a deal with Tesla. They're a lithium company. And I thought, okay, shouldn't you be studying this? Have you looked at the price action? Have you looked at the charts? Have you looked at any research on the company? No, I'm just, it's a punt. And it's gone really well. It's nearly doubled in a week. So, luck is what it is. Some people have it, other people don't. I got
a Carl Icahn, who's this hedge fund manager, definitely knows what he's doing. I got a quote of his printed on a hooded sweatshirt that I bought the other day, and it said, don't confuse luck with skill, especially when judging oneself.
I think that's the important lesson, isn't it? Yeah.
And that's the thing, right? Because your friend in this context, he might now think that his methodology, to your point earlier on, and how this all feeds back, he might think that that's the right way to invest in the stock market, right? And maybe that he parlays those winnings, if you like, to use a gambling analogy, those winnings into the next thing that he rolls the dice on. Yes, and I just don't, that we see this come horribly crashing down on occasion. So many good principles in here, Phil, that we've touched on that, if people just tuned in for the last 30 minutes to this conversation, and maybe they need to replay it once or twice, I think that's so profound how many ideas are in this 1 30-minute conversation, and we can't do justice to them all. So you have a podcast series called Shares for Beginners for people that want to listen to it, and you've got a website, sharesforbeginners.com, if I'm not mistaken.
Yep.
Is there anywhere else? Are you on social media? You mentioned you have a group.
Yeah, Facebook at Shares for Beginners on Facebook, the group and the page there, and on Twitter you can follow me at Phil_Muscatello as well, though. I just really do more posting about episodes and when they come out rather than getting involved in too much of the Twitterverse, which you could get lost in.
It can be a bit vicious at times.
I don't think it's too bad. The financial services side of Twitter is remarkably polite, I find.
Oh, well, maybe I'm in the wrong forums, but wrong threads. I often find it someone said to me, this is an interesting point, Phil. Someone said to me the other day, and he's a really good analyst. He said, I think I learned more from who I follow on Twitter than I did in my master's degree in finance. And I just had to step back and think about that for a moment. And I thought, there are so many great people on Twitter that you can follow. I guess you just need to be careful who you follow.
Okay, maybe I'm not following you. I thought I was following you, but I obviously must.
I'm sure Owen will put himself into the great people category.
No, I don't know about that. Phil, thanks for taking some time out today. I think our listeners will think, this Phil guy sounds pretty switched on. He doesn't say he's an expert, but he definitely sounds like it. And the way you deliver messages is first rate. So
thank you. And really enjoy what you guys are doing as well. Thank you very much. Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation. Thanks to Christopher Soulos for music production with that special Greekalicious flavour. Remember, music always flows, even when the money won't.
At Staples Business Advantage, our team of experts can help you find the breakroom products to satisfy everyone's preferences, while AI can
Suggest popular items, monitor stock levels, optimize pricing, and automate reordering.
AI can do a lot of things.
But I can never know the taste of a truly great cup of coffee. Sigh.
But you also can't get hangry.
This is true.
Let Staples Business Advantage use today's latest innovations, plus our team's experience, to make stocking your team's break room easier for you.
Sign up today and save 20%.
Staples Business Advantage.
Business is
Human.